In this lecture, we'll discuss Chapter 5 or Assignment 5, Enterprise-Wide Risk Management. You'll find that much of what we discuss in this chapter is very similar to what we just discussed in Chapter 1 of the CPCU text. But enterprise-wide risk management is a slight departure and an advancement or improvement over traditional risk management. So while you will see some of the same concepts, you'll see that they've been altered over the years in terms of how businesses and individuals approach risk management, particularly in the corporate world. I like to think of enterprise-wide risk management as risk optimization, and it is sometimes referred to in this way in the textbook and throughout the industry. So let's take a look at the different topics we'll be discussing today. First, we'll look at traditional versus enterprise-wide risk management. Then we'll look at how enterprise-wide risk management can be used to improve strategic decision-making. And last, we'll look at ERM in approaching business uncertainties. First, traditional versus enterprise-wide risk management. We'll talk about risk categories, strategic integration, performance metrics, and organizational structure. Before we compare traditional to enterprise-wide risk management, let me explain why we skipped 3 chapters. I believe that this chapter is one of the best chapters in the entire text for helping you to conduct your risk assessment. The risk assessment that you ultimately do for this course should take an enterprise-wide approach as opposed to a traditional risk management approach. Therefore, while all of the other chapters in this class are important, I think it's critical that we cover enterprise-wide risk management now that we've already discussed traditional. So let's begin with a look at risk categories. So these look very much like the 4 quadrants of risk we discussed in Chapter 1. Operational and hazard risk are lumped into one category. This is the focus of traditional risk management, whereas the focus of enterprise-wide risk management is the entire pie. Let's break down these characteristics a little more. Just as in traditional risk management, hazard risk is only pure risks. But in enterprise risk management, we acknowledge that operational risks includes both pure risks and speculative risks. If an employee makes a mistake, that might involve pure risks, but an employee doing their job more efficiently and better could result in a gain, and therefore should be considered speculative. Then there's strategic and financial risk, which of course is only speculative risk. But the world of enterprise risk management focuses on all 4 of these and any other risks that don't fit neatly into this category. The question that enterprise risk management asks is, what is a potential opportunity for your business that could create risks? This is a focus on growth and expansion, and not just on continuing business operations. However, enterprise risk management does continue to ask the same question: what risks does your business currently face, and how are those risks changing in a changing environment? Now let's discuss strategic integration. Decisions are made considering all quadrants of risks instead of each quadrant in isolation. Under enterprise risk management, you should identify the risks in each quadrant for a new business endeavor or for your business. Throughout this lecture, I'll refer to your business. Right now, you may not have selected a business to do your risk assessment on, but once you begin the risk assessment process, which is the paper for this course, you might want to review this lecture. And remember that when I refer to your business, I'm referring to the business you'll be doing your risk assessment on. Now let's look at the exposure spaces model, and it can be found on page 5.7 of the CPCU text. The dimensions of enterprise risk management include first, exposure identification, which we did discuss in the first lecture, property, liability, business income, and personnel risks, and then potential opportunities for the business, which have potential positive impacts, and threats to the business, which are negative impacts, and finally, perils or events, causes of loss. This is similar to what we discussed in terms of the characteristics of risk, but it adds this aspect of risk, which is that many times risk can actually be positive. But taken as a whole, you must consider exposures, perils, opportunities, and threats. Next, we look at performance metrics. Performance metrics are the way that you measure success of your organization. Traditional risk management measures success in terms of both activities and results. In other words, you might ask, as a business, how much do you do in trying to manage your risks? For example, you might say, we held 6 trainings in a year to show our employees how to act more safely. Or we installed 5 guardrails around our building. Traditional risk management is the number of activities or actions that you undertook to manage risk. Then you might also ask, how many fewer accidents result? So these are 2 important questions that can be asked to measure success. However, is there a better way of measuring success? Enterprise risk management looks at risk optimization overall because more risk control measures and fewer accidents will not always result in closer achievement towards goals. For example, sometimes risk tools like goggles and back braces actually slow your employees' productivity down. There might be a better way that your employees can continue to be just as safe or safer and yet be even more productive. A quote from the textbook, eliminating all risk in business would be tantamount to terminating the organization's operations. ERM seeks to optimize risk-taking in relationship to strategic goals. So in other words, taken in the extreme, traditional risk management would mean discontinuing activities. The reality is that business is risk. We all have to take risks in our life and in our businesses in order to enjoy our life and to gain rewards. You know the saying, no risk, no reward. So enterprise risk management acknowledges that we must take risks, but we must optimize our risk-taking, not necessarily by minimizing risk, but by reaching an equilibrium between risk minimization and reward maximization. Enterprise risk management also considers organizational structure. Under traditional risk management, a risk manager or chief risk officer, as they're now often referred to, reports to the chief financial officer. But under ERM, risk management responsibility is decentralized. The CRO reports to the CEO or the company's board of directors. The chief risk officer is an educator and a coach who helps to create a culture where department heads are risk owners. Take a look at the risk management versus enterprise risk management example on page 5.8. This is a great example that shows the difference between risk optimization and risk minimization. A quote from page 5.8 is, an organization with a fully integrated ERM approach develops a sophisticated but user-friendly approach. There is a concern that an organization who takes an enterprise risk management approach could develop an overly complicated approach. But an approach that works best is one that everyone at every level of the organization can understand, embrace, and execute. Now let's discuss improving strategic decision-making with enterprise risk management. Let's look at another quote from page 5.11. ERM is not exclusive to the corporate world. Sole proprietorships, partnerships, government have all benefited from integrating ERM with strategy. You might think that it only makes sense for a large corporate entity to embrace enterprise risk management, but even small businesses and partnerships and government entities can benefit from incorporating risk optimization or enterprise risk management within their corporate strategy. The reason for developing a strategic plan is the recognition that an organization's business model will not survive indefinitely. Risks to the business model can arise from changes in competition, technology, the market, and customer demands. And especially in the modern economy, where technology and global expansion have created numerous opportunities and threats, it's absolutely important that all sizes of business approach risk from an enterprise risk perspective. Now let's look at the steps to enterprise risk management. These are almost identical to the steps of traditional risk management. I'll make note of differences as we walk through the steps. To begin with, You must develop enterprise risk management goals. This is considered even more critical from an enterprise risk management standpoint. Remember, as we discussed in ARM 2005, you have to know where you want to get to as an organization before you take any future steps. Then you identify risks, of course. Then you analyze, evaluate, and prioritize critical risks. You treat critical risks considering the order of their priority, and last, monitoring critical risks. Let's look at each of these more closely. To develop the enterprise risk management goals, you must base them on the organization's risk appetite, purpose and need for an enterprise risk management program, the intended scope of the enterprise risk management program, and a definition of ERM. Everyone that owns or works for an organization, whether full-time or part-time, or even a consultant, must understand and agree upon the definition of enterprise risk management for that organization. It also has to be understood whether the organization has a function-based culture or a collaborative culture. In today's economy, collaborative cultures are becoming much more common. It's important that everyone in the organization, from top down and bottom up, agrees and understands the culture of the organization. Take a look at sample ERM goals on page 5.14 of the CPCU text. Think of each of these as the purpose of risk management. Let me just name some of them. One says, anticipate and reduce deviations from expected outcomes, and anticipate and recognize emerging risks. Then drive consistency in risk-taking. Optimize risk-taking, considering appetite and tolerance. Reduce earnings volatility. And then moving down, enhance the safety and health of employees, customers, and their communities. And boost internal and external stakeholder confidence and trust. Enable better informed governance. And improve external transparency and risk disclosure. Establish cross-functional and organizational awareness of risks posed in specific geographies. I think that this table, Sample Enterprise Risk Management Goals, provides an excellent justification for the time spent on enterprise risk management. Next, of course, identify your risks between property, liability, personnel, and business income exposures. And then, of course, analyze, evaluate, and prioritize, especially paying attention to critical risks. When taking an enterprise risk management approach, you should consider competition, customer demographics or behaviors, in other words, changes in age, ethnicity, and other consumer preferences of the population that might potentially purchase your goods or use your service, technology, the economy, politics and regulation, and the organization's ability to meet regulatory requirements. You also have to answer the question, is the residual impact for the critical risks within the organization's tolerance level? If your answer to this question is yes, you can go right to monitor your risk approach. If not, you have to select one of the techniques. Then you must treat critical risks considering the priority of each risk. Remember, the choices are avoid, accept, transfer, and control or mitigate, which is defined in the chapter as initiate activities to reduce the probability, impact, or timing of a risk event to an acceptable risk tolerance for your organization. One additional treatment method is added with enterprise risk management: optimize or exploit, which means to develop actions to optimize positive consequences to achieve gains. The last step is to monitor critical risks. From page 5.16, monitoring risks to strategy is complex because the triggering events must generally be identified from a variety of sources, including, for example, industry newsletters, regulatory announcements, and surveys. Think about how important this is, for example, when considering the reputation of an organization. In this last section, we'll discuss how enterprise risk management is much more useful in approaching business uncertainties than traditional risk management has been. First, we'll discuss enhanced decision-making, and last, improve risk communication. Enterprise-wide risk management can result in increased profitability for the organization because, again, you're willing to take on risks that you might not otherwise have taken, but simply reduce the volatility of losses. Then, You improve your ability to meet strategic goals, and this also results in increased accountability to management as well as to owners in the organization and other stakeholders like customers and regulators. And last, it results in improved risk communication. By definition, management must work together to come up with an enterprise risk management approach. Therefore, you achieve management consensus, and hopefully consensus throughout the entire organization, particularly if this is a collaborative culture. And you achieve stakeholder acceptance. Stakeholders, again, are not only your management and employees, but also your customers, your partners, and regulators, and even the community at large. This can be especially complicated, but all the more important in our more global, technology-driven society. And that concludes our discussion of enterprise-wide risk management.